All right, good morning and welcome back, investors and traders, Finom Group members from all around the world. As you can see, we are at new all-time highs in the stock market, and by that I mean the S&P 500. The Nasdaq 100 has also made a new all-time high, but just a hair's stone throws away from an all-time high on the Nasdaq Composite. And it didn't appear earlier this year. We're still in the month of January, but as we started off the new year, the markets were consolidating the gains from the Q4 period. Santa Claus rally did not achieve a bullish feat of strength. The first 5 trading days also delivered a negative return, and the sentiment started to turn in favor of the bears at the beginning of this year. And then all of a sudden we had monthly options expiration. We had a pretty good rally to end the week just this past week, setting up 2 consecutive weeks of gains to kind of offset the way we started the new year. So with that being said, new all-time highs, Beget, well, historically new all-time highs. The market just doesn't turn around, and we've got some data to validate that statement, keeping in mind that we don't know what the future holds. Uh, the future is not guaranteed to us so far as being an investor and what the markets are going to do. Having said that, when we look at history, when we look at a lot of the historical data, it lends itself as a very useful guide. History doesn't always repeat, keeping that in mind, but it does often rhyme. So with that said, let's dig into some of this week's content and see if we can decide or decipher what the forward probabilities are for the markets and as that pertains to us as investors. All right, so coming into last week, all right, every week here at Finom Group, we have a weekly macro market research report. And as usual, if you don't receive our reports, subscribe today to get our weekly macro market research report and access to all of our content on site. You can also become a premium member. You can have all the content on site as well as be a part of our trading groups that we have via Twitter and Telegram. Get all of my personal trade ideas, investment ideas throughout the course of the week, the month, the quarter, the year, and access to our live streaming trading room Monday through Friday, 8:15 a.m. to 4 o'clock, the closing bell. Again, that's Monday through Friday. But one of the things that we had talked about last week, as the trading week kicked off, we said, no matter how many different data sets, seasonal patterns, election cycle studies we look at, they all point to the same bullish long-term outcome. The same bullish long-term outcome. And many point to short-term weakness. Weakness is a relative. Keep that in mind. Weakness is a relative term. It's subjective. With little movement in the indices year to date, we can safely say at least 2 things, and please consider them for what you are currently holding in the way of near-term expectations. Number one, the early 2024 market energy does not match late 2023. And number two, up is proving just as difficult as down, right? The markets seemingly got stuck. You get these fits and starts to begin the year, but we pretty much went nowhere. The Golden Capital portfolio, which I manage, remains with a buy and hold and buy the dip and accept near-term drawdowns volatility as part of the price one pays for future returns. In other words, we see any potential near-term weakness, drawdowns in the market, consolidation, call it what you want. We see that as opportunity. Even if we were to achieve, consolidation in price more so than in time, we would just look at that as opportunity, not as a means to start selling and panicking and things of that nature, but true opportunity. What we have as core holdings in the Golden Capital portfolio, we're not writing calls against, we're not hedging. We know drawdowns are part of the price you pay for future returns. Don't get cute with the market, folks. So again, this was going into last week's trading, the monthly options expiration week. And I think, yeah, you can see this was our January 14th macro market research report. And one of the segments, we kind of bottom line some of the data, some of the charts that we had been looking at. We basically bottom line it right here. There you go. No matter how many different data sets, this is a way to, again, set your psychology, right? Keep a low expectations. If the market jumps over those expectations, because we had the opinion, as you scroll through our macro market research report, that with the first week of the trading year, the first 2 weeks, the market basically going nowhere, that we were seeing patterns of risk off behavior. So we thought there might be more consolidation in the works last week. And indeed, that is exactly what happened. Through Wednesday, the market was down. We were down about 1.5% on the S&P 500 to start the year, to start January. Things weren't looking all that great. But then Thursday, things turned around, and Friday, through monthly options expiration, we took off. So in a sense, we were right. We had the right posture going into the week, keeping in mind that a lot of investing is psychology. So we are at all-time highs, and there's a lot of fear. People don't want to buy at all-time highs. They have this hang up that they buy all-time highs. Well, there's only one way to go, down. That is really what people think, despite the history of markets, and that's what this bar chart here outlines. What if I told you that buying the top versus buying literally any other day, the difference between buying the top and any other day in history is only about 1%? The average 1-year return, if you buy the top versus any other day, only all-time highs. So if you bought only all-time highs a year later, return 11.6%. But look at buying any other day, right? Because we think about buying pullbacks rather than buying the all-time high. It doesn't matter. You buy any other day, you're basically 0.9, less than 1% difference than buying the all-time high. And we can go out 3 years, we can go out 5 years. The story doesn't really change. There's roughly a 1% difference buying the all-time high versus any other day going out 5 years. So this is what people are nervous about. This is the anxiety that they're willing to store up, in their bodies because the market is at all-time highs. Makes no sense. The data tells you, don't worry about that. And in fact, again, what do new all-time highs usually beget? More new all-time highs. Most calendar years don't have one new all-time high on a particular trading day for that calendar year. No, it's usually 20 new all-time highs that year, 30, 40, 50, 60, 70 new all-time highs if we go back to 2021. Right? Remember, I think we had over 70 days that we traded at a new all-time high. All right. Next up, what I often hear is, well, I'm back to even. I'm just gonna, take my chips off the table. I finally got back to even. For me, that was a strong discipline. I held through the downturn of 2022, rode the wave in 2023, and now I'm back to even. So I'm just gonna get out. Bad idea. Bad idea, folks. Again, most of the time when the market gets back to even, there are additional gains to come. Don't think in terms of breaking even. You're not in the business of investing to break even. And think about what just happened, a new bull market in 2023. How many times did the bull market deliver a negative return in year 2 of a bull market? Goose egg, 0. Year 2 has always delivered, a follow-through. It's called a follow-through year. In the history of the S&P 500, dating back to 1957, the market has been up in year 2 of a new bull market. Some of the things I warned people about last year, especially the bears, right? We had that whole banking crisis situation, mini banking crisis situation back in March, and then April came around. We started to rally, but the bears, they weren't willing to see it. No, no. The banking standard, lending standards are going to tighten further. Liquidity is a problem. Look at LEIs down, at that time, 12 months in a row. Look at the outperformance in consumer staples that was leading the market up to that point in the year. We had a 50% Fibonacci retracement failure. You give the bears everything they could possibly want, and of course, what do? They trap themselves. Folks, there's no such thing as a bull trap. The market goes up over time. There's no logic to suggesting there's a bull trap for the markets, but there is a bear trap because the market does not go down over time. Just because there's a yin doesn't mean there's a yang in the markets. People have this belief that everything is mean reverting or reciprocal. It does not work that way in the markets. Just because there is a bear trap potential does not equate to there being a bull trap potential. No, a bull trap is when you just break even. You do that to yourself. The market will go higher over time. The only bull trap that exists is the ones that we push, onto ourselves because we do lose discipline. All right, moving on. Some of the studies that we looked at coming into this year, helped us to identify what were the probabilities of another positive return this year, as well as, for January. Is January going to be up or down? It's called the January barometer for a reason. People look at, how January goes. The saying is the full year goes. Well, one of the studies we looked at was the VIX. And when the VIX closes the calendar year below 14, historically, the forward S&P 500 12-month returns are almost always positive. In fact, the only time it wasn't was 1 year later in 2018, negative 6.5% return. This is total return basis. So historically, more often than not, going back to 1990, which is when the VIX was created, if you finish the year below 14 on the VIX, the forward probability that there will be a positive return, in the next calendar year is very, very high. The other thing that we looked at was more recently, the VIX actually had what we call a mini spike off of the lows. It touched below 12 very briefly and then rose for the first time in at least 1 month above 14.25. This study coming from Nautilus Research. And so when that happens, when you get kind of a mini spike after being below 14.25 for the first time in a month, historically the forward returns and the signal was on 1.5. So if we look out 1 month, well, historically, the S&P 500 has done well. That VIX spike proves it was just a mini spike and things settle back down and the market moves even higher. So maybe by early February, we'll take a look at it and see if we have a 10-to-1, 9 times up, only 1 time down after this particular criterion or signal. Moving on. Recall, we had a 9-week winning streak to end the calendar year 2023. S&P 500 up 9 weeks in a row. Very rare. You can see here since 1957, what do we have? 10 prior occurrences. 1, 2, 3, 4, 5, 6, 7, 8, 9. No, this was the 10th occurrence to end the year. Now, 1 week later, market typically is only up 33% of the time. So that means 67% of the time, a majority of the time, the market does not have a 10-week winning streak. Lo and behold, what happened the first week of the calendar year? The market was down. So this probability played out beautifully. 2 weeks later, however, the market, it's a coin toss at 55%, but we were up. Here's again talking about January. What are the probabilities that the January barometer will be positive? The January barometer is basically the market, S&P 500, delivers a positive return in the month of January. Well, based on just the 9 week winning streak, unfortunately, it did signal at the very end of the calendar year. So when we look out 1 month later, basically to the end of January, how clean is that? Um, the market is up 88% of the time. So by January 29th, we will see if the market has delivered that positive return from the closing date, which I believe was 47.69. Now, most of you know we're at all-time high, so right now we're up, but all that matters is where we are on the 29th, so far as keeping this high percent probability rate. But this did lend itself very well while the markets were kind of fluctuating here in the early part of January. It lent itself to how you should, engage that somewhat uh, weaker than expected price action. It was a buy the dip opportunity. And we are at new all-time highs. This study that we've gone over several times in past videos from FundStrat talked about since 1950, there are 11 instances where the S&P 500 fell 20% and then climbed to within 1% of a prior all-time high. Now, in all 11 of those occurrences, so 11 out of 11 times, the S&P 500 did make an all-time high. The median time period that it took was just 7 trading days. The longest it took was 20 days to make that new all-time high prior to this occurrence. You know how many times it took us? Once we got within 1% of the former all-time high, it took us 21 trading days. But talk about a useful guide, right? So if your expectation was that, okay, we're within 1% of an all-time high, history tells us that within a median of 7 days, we should be at an all-time high. In the longest 20 days, again, that early weakness to start the calendar year should have been recognized as a buy the dip opportunity. More than likely within 20 days, if you had bought the Spider ETF, you would have had a higher price, ergo a positive return on that trade. And that's how you use this kind of quantitative data. Looking a bit at the macro picture, or the fundamentals, if you will, we're in earnings season, and profit margins are expected to contract on a quarter over quarter basis, right? So we're reporting, or companies are reporting their fourth quarter 2023 results, and that might scare people. Well, then how can we have a positive outlook on 2024 earnings if margins are already contracting? But keep in mind, just like most other things that we look at in and around the markets, they are cyclical. They have seasonality to them, and so do earnings. Typically, your fourth quarter is your weakest margin period. Why? Well, think about what goes on in the fourth quarter, holidays. And we'll think about what retailers are doing. Retailers are discounting, right? Retail is all about discounting. So wouldn't you expect or anticipate that that has a seasonal impact on profit margins? Absolutely. So if we look at this as the estimate in Q4 of 2023, that is lower than Q3, lower than Q2, and even lower than Q1. But if we go back to 2022, here's the Q4 period also. And look at that, lower than Q3, Q2, Q1. 2021, same thing. This is lower. The Q4 profit margins lower than Q3, Q2, and Q1. In fact, generally the only time that margins are better in the Q4 period than other periods is if you're coming out of recession. So you have this momentum where all company profits are starting to accelerate. And that's exactly what we saw in 2020 coming out of the COVID lockdowns in the Q2 period. Q3 profit margins, Q4. But that is generally the only time Q4 profit margins are stronger than the other periods. So don't worry. Don't worry that Q4 profit margins are actually repeating the history and the cyclicality, of the quarterly cycle. All right, moving on. A lot of talk about will the Fed or won't the Fed? Are they going to cut in March, or are they going to cut in the Q2 period or the Q3 period for the first time after hiking rates since basically early 2022. Here's what I'd like to show you or identify using this chart, right? Because there's a lot of punditry that says that no, there's no way they're going to cut at the March meeting. And I'm of the opinion that they will. I could be wrong. It happens. We're not trying to be perfect here. In fact, what should be elevated is the fact that we're talking about cuts. When they happen is less important than them actually happening. Okay. Going through the exercises of when is less important than the fact that they are going to cut, assuming that the trend of disinflation remains constant. And by all accounts, by all measures in the data, we do see that continuing here in the through the first half of 2024. But historically, and this is a chart of CPI going all the way back to 1970. So you had the spikes in CPI in the 70s and early 80s. We even had a mini spike there in 1990. Right, that was the Gulf War, and then of course the 2022 spike. But you'll notice we are currently below this horizontal line. All right, because today CPI is 3.4%. Now, if we go back to the 70s spike, it took 1, 2, 3. We didn't actually get below 4% after the 1970s spike in inflation. Did they eventually cut rates in the 1970s? Yes, without CPI even being below 5%. Then we had a secondary spike in inflation in the early 1980s. But look how long it took. It wasn't until I think this is 1986 for the CPI to get under 3.8%. So from 1982, it took another 4 years to get to just 3.8%. We're already at 3.4%, folks. People are saying, well, they can't hike because it's not at target. It wasn't at target any of these times. I'm sorry, they can't cut because it hasn't hit the Fed's target rate. Again, it never hit the Fed's target rate here, and they cut in the 1970s. They also cut in the 1980s without it getting to the target rate. So this is the fastest pace of disinflation we've seen once the CPI has gotten above 9%. It has gotten down below 5%, below 4% at the fastest pace if we're just going back to the 1970s. So when people say, oh, well, it's slowly coming down. No, well, it demands context. Is it coming down slowly? Yeah, when you're in the moment, it feels that way. But relative to history, this is the fastest pace inflation has unwound. Keeping in mind that inflation is very symmetrical. If it goes up quickly, it comes down quickly. And that is what happened. It is what is taking place here today or in this particular cycle. Looking again at macro, I was of the belief that the ISM manufacturing index, based on all the data I look at, based on all the studying I did, all the research, that the ISM would come back to 50 by the end of the calendar year. We got very, very close. It got into the 49s before retreating once again. And one of the main reasons is, remember that the ISM Manufacturing Index, this is a survey. It's a question and answer. It's not hard data. It's how do you feel? Those surveys you should be very skeptical of. One of the biggest reasons why that we've had now a 13 or 14 month long contractionary period in the ISM manufacturing is because of the disinflation cycle. Right? These wholesalers, these folks that are providing the service of manufacturing and production, they're having to lower the prices because of the disinflationary cycle. So when they're answering these questions about how they feel about their business going forward, whether it's employment, whether it's prices, so on and so forth, how do you think they're going to feel knowing that their margins are contracting? So why do you think the surveys are in such piss poor shape for so long? The NOPE index, which you're looking at right here, kind of lends itself to identifying what or why manufacturing on a survey basis, soft data, has been in such a long period of decline. Nope is taking away the price component. So it's a factor of new orders minus price. NO is new orders subtracted by price. And when you do that, the ISM would actually be in positive territory above this zero line here. And historically, that's actually bullish for the S&P 500. Above zero equals bullish for stocks. Again, looking at the macro through the lens of a disinflationary period to understand the whys. Why is manufacturing stink for so long? Well, it really doesn't. It's just sentiment does because we're in this disinflationary period. So yield curve, yield curve, yield curve. Well, the yield curve inverted, so a recession's on the horizon. Nope. Actually, when it uninverts, that's when a recession signal triggers. I mean, you can't win with the yield curve, right? It's inverted, recession's imminent. No, it's when it uninverts, that's when the recession is imminent. The reality is there's no signal historically from any of the yield curves. It doesn't matter which combination of the yield curve you want to use. And then, more recently we heard, well, it's what the Fed looks at. The Fed is looking at the forward yield curve. No, that's wrong also. And this is the forward yield curves that are highlighted here from the Federal Reserve. They did a recent study, and their own study debunked the myth that the forward yield curves have a more are a more predictory signal of forward four-quarter GDP or next year's GDP. Folks, almost none of them have a greater than 0.50 correlation coefficient with four-quarter forward real GDP. None of them. You need at least that to be a reliable signal. None of them have it. The yield curve does not. Think about this. The 3-month, right? This used to be what the Fed mostly looked at when it came to yield curve inversion and a possible recessionary signal. It's the 3-month and the 10-year spread. That one has only a 0.36% correlation coefficient. And the duration historically between the inversion of that particular yield curve and a recession taking place is 2 years. Well, 23 months. 23 months to get to the recession. That's one heck of a lag signal, don't you think? Imagine you punched Mike Tyson in the face. Do you think Mike Tyson is waiting 2 years, almost 2 years to punch you back? No, right? I mean, that's what you should think about in terms of cause and effect. So does the yield curve really signal anything historically? There's no data to suggest it does. None. All right, with that being said, last but not least, let's do some debunking of myths out there. I've seen this chart floated around, and it's from Torsten Slok of the Apollo Group. He was kind of the darling of the economist or macro strategist prior to COVID. But since COVID, he's gotten literally everything wrong. Another goose egg in terms of, efficacy rate from his analysis and, his outlooks on the market and the economy. And hey, it happens. It's a tough job. With that being said, he recently outlined this particular chart of money market fund assets. And look, they're at record highs. And he says, Torsten says, the record high 6 trillion in money market accounts is likely a tailwind to equities, credit, and rates, and ultimately the economy, in particular, hiring, housing, and inflation. The record high 6 trillion in money markets accounts is likely a tailwind to equities, right? So the assumption here is that money would come off of the sidelines from money market funds into the equity markets. The last time that happened was never. His own chart. Where do you see the siphoning here from money market? You know how you get to all-time highs? You know how you get to 6 trillion in money market assets? They're sticky. They stay there and they just compound over time. That's how you get there, not by them siphoning out. In fact, the only reason they had dropped in the past, this is your great financial crisis, is because people wanted their cash back. They'd rather put it under their mattress. They know it's there, they can access it. In fact, that's the only time money really comes out of money market funds. And here it was in 2020 during COVID. People wanted their money out of the bank. It's the only time it comes out of money market funds. It's ridiculous to suggest that this is a tailwind for equities. Well, Seth, that doesn't sound very bullish. It's a non-factor. It's not about being bullish or bearish. It's a non-factor. This is ridiculous. Just look at the chart, people. Money just doesn't come out of money market funds. It just doesn't. They're sticky. They stay there. Most people don't do all of this, transitioning from one asset class to another. Most people just don't do that. Here's another chart, that kind of want to debunk the myth about trading days from and again, this goes back to, everything, financial media, social media. People love to find things that'll be bearish for the markets. Trading days from first Fed rate cut to the S&P 500's market low. So this is basically insinuating, no, it's not when the Fed raises rates, it's when the Fed cuts rates that the market starts to tumble. But what you'll notice here is that these were all hard landing scenarios. That's what we're looking at. Recession came after 1989 when they started cutting rates. Started cutting rates in 1987. But this is how many days it took to make the market low. So that's what you see. And the average was from the first cut, the average was 200 days later, the market was making a lower low. Where's 1994? Where's 1962? Because those were all soft landings. Where's 2019? None of that's in here, right? So this is a specific study that's trying to talk about recessions and market lows, bear markets, right? This isn't really taking all the cycles where the Fed has started cutting rates. It's not. There's no 1962. There's no 1994. There's no 2019 in this chart. So how are you getting a true picture? You're not. You're getting somebody who decided this is the only thing they want you to see. And it's the same thing in this table right here. Where's 1962? Where's 2019? And where's 1994? It's not in any of these dates. This is just the same thing in a different configuration as this chart right here. This is just the table form, right? People want you to see what they want you to see. You've got to be a bit more discerning than that, or these can kind of fool you, right? This is not all encompassing rate cut cycles. It's only encompassing the ones that led to a recession and kind of bearish outcomes for the market. We talked about coming into this year some serious thrust. So we don't want to lose sight of the dueling Zwig breadth thrust. We had 2 Zwig breadth thrusts to end last year. Speaking of the things that we might anticipate for 2024 in the way of price action. Historically, 6 and 12 months later, after a Zwig breadth thrust, the market has never delivered a negative return. That sets up very well for 2024. We've talked about the toy barometer from Wayne Whaley, right? The toy barometer period started November 19th and it ends January 19th. Well, it just ended. Did we fire a bullish, a bearish, or a neutral toy barometer signal? It was bullish. Again, that might offset, some of the weakness in the first part of the year, failed Santa Claus rally and a failed first 5 trading days of the calendar year. We still have, the January barometer left, but the toy barometer has fired for the 38th time in history going back to 1950. Of those prior 37 bullish signals from the toy barometer, only 2 calendar years delivered a negative return. One was 2018 and the other was 1987. That's it, 2. So 35 and 2. 35 up or positive returns in that 12-month forward period and only 2 negative returns. What's that, 94, 95% positivity rate? You want to lean into that, folks. Here's a study I looked at also, right? Because we went from a down 2022 to an up 2023. what's 2024's probabilities after a down then up year? Well, historically, 86% of the time after that down up period, the following year is up again. In fact, the last time we had a down up and then another down year was 1961. That's it. Only 3 times historically. In fact, going all the way back to 1933. The average return in that second year is 13%. It's the average. I'm sorry, the median return. That's the median return, even better. Next study, this is our last study of our video here. The S&P 500 just hit an all-time high for the first time in at least a year. And so if we go back to 1956, the S&P 500 has been higher 12 months later with a median return of 13.5%. Again, this is first time we make an all-time high in at least a year. The only loss, of course, was, in 2001, basically. And we know what happened in 2001, folks. Are you really betting on two morons, flying their planes into the World Trade Center, right? Is that your way of assuaging, the positivity rate and possible outcome for returns this year? That's what you're doing. You're in the wrong business and you're following the wrong people. There's a lot of folks that are bearish out there. I know that. I see it every week. And we think of these people as very qualified investors. They are anything but. I'm going to give you an example here. And I really hate to do this. No, I don't. Because people shouldn't. You don't sell fear to people. You don't. That's a terrible thing. Not because Seth says so. Warren Buffett says so. If you're not going to take it from me, take it from Warren Buffett. Fear is a terrible thing to sell to others. Here was a tweet from David Keller, right? CMT, Certified Market Technician. You must know him he's one of the founders, and he's the chief equity strategist at stockcharts.com. I've taken his workshops many times in the past. Great dude. I mean, he's just a fantastic person. He's a terrible investor. Terrible by my standards. My standards are you need to at least market perform over your career as an investor. He doesn't do that. Not because I don't want him to, he just doesn't. I've taken his workshops. He admits to, approaching investing from a very cautious standpoint. And that's okay. We're all different. This goes back to, what's your emotional quotient as an investor? Because that's what it's about. It's not this. It's not your intellect. It's your emotional quotient that drives your ability to generate above average returns. David doesn't have that ability. Again, not because I don't want him to, and he demonstrates it. This was his tweet on January 4th. The McClellan oscillator has moved below zero. And indeed, that's a fact. It moved below zero. But he goes on to say, and no, that is not bullish for S&P 500 returns. Now, what has happened since then? Well, we all know what has happened. The market went higher. Not because of the McClellan oscillator dipping below here. It went higher because we had all this breadth momentum. We're still in this buy the dip, mentality of market behavior right now. He didn't recognize that. From a textbook standpoint, as a certified market technician, this is a fact. Typically this is not optimistic for price action in the S&P 500 near term. I don't care about that. What I care about is your posture, how you perceive what is going on in the market, whether it's technically, fundamental, whatever. How you approach and engage these stochastics, technical analysis, is going to drive how you generate returns from the market. Using the same McClellan oscillator, but for a different index, although they were all negative, right? Here's the reading on the NASDAQ McClellan oscillator. Same thing, it fell below zero. Look at how I annotate the different levels within the McClellan oscillator. Overbought tactical bull, neutral bull rider zone, the neutral bull holder zone, and an oversold savvy bull. Where's this bearish? Where do you see that? And that's the difference between somebody like David, who is certified. But what I want you as an investor and trader to focus on are people that are qualified. And in my book, the text by Seth Golden, you're qualified based on your performance, because your performance will inform how well you engage price action, how strong your emotional quotient is. Here's another example. Again, facts are facts. We know what just happened. You saw the difference in how I annotate, how I perceive price action, how I look at stochastics versus somebody like David Keller. Well, here's another person who is, again, another CMT. One of the things I've often said about certified market technicians is they're always hunting for problems. They're always looking for issues in the market. So they have this kind of posture that doesn't lend itself so well to being bullish or engaging weakness in the market from a bullish perspective. This is going back to October 20 of last year. And remember, we hadn't even bottomed during the corrective wave back then. Willie Delwich, you know they're more interested in being right than making money if they keep talking about this being a bull market. Obviously, he didn't think this was a bull market in 2023. Now, we all know what happened. Market bottom, right, from that corrective wave on October 27th, and went on to make more 52-week highs, getting to close to 1% of the all-time high. These people don't change their stripes, folks. They just don't. They don't change their fur coat, I should say. Here he is just a few days ago. Just a few days ago. S&P 500 had everything going for it in December and still couldn't break out. That failure to launch is important. That failure to launch is important. You have to go back to the 1950s to find this long of a stretch without a new high that occurred outside of a... He still thinks this is a bear market, folks. You can't change some people, no matter what the price action is. It did go higher after this. He didn't care. It didn't make any... They changed their criterion also. Right? No patience here. He didn't have patience here. Just wait. Things will get better. He didn't have patience here. And what happened? 2 trading days, 3 trading days later, new all-time highs. Just how some people are, folks. With that being said, thank you for joining me here this week on our weekly video. As always, if you don't have access to all of our weekly content, our macro market research report, our trading room, our trade alerts, our investing ideas, subscribe today at phenomgroup.com. Take care, everybody, and safe trading.